loss basis, which meant that an event or an unfavorable event would have happened first, then you make the provision for doubtful debts or an impairment. But moving into IFRS 9, because of certain events that occurred in the United States, some of the businesses has failed due to the provisions for impairment are being made too late, then the standard setters have felt that we need to relook into the impairment loss model and take into account earlier an expected credit loss before it actually happens. So when it happens, you don't take a significant hit into the financial statement. So that was one of the major change in introduction of IFRS 9. So later we'll look into specifically how that impairment is expected to be performed. But before that, we will need to firstly understand the scope of IFRS 9, and also how do we classify financial assets and liability that will drive the measurement principle. Okay, so at the end of today, we will understand the basic underlying principles of IFRS 9 and how do we classify and measure both financial assets and financial liabilities, understand the requirements of IFRS 9 for their impairment model for financial assets, and understand what constitute a modification and how do we account for them. So we will see an example of how do we compute a modification from their 10% test, right? So later I will explain what is this 10% test for modification. Okay, now the IFRS 9 model for financial asset looks at two main things when we come to classification and measurement of financial asset. And that is the business model and what we call the contractual characteristic test. Or in simple form here, I just put the word cash flow. Okay? So depending on whether contractual characteristic test, of which we are saying that the contractual characteristic that meets a solely payment of principal and interest would be what we call the SPPI for short. So for the rest of the day, I will use the term SPPI. Okay? So for business model, we have potentially one type, two type, or any other. So I put in the category of 3 later on. So if we have a business model, which is to held to collect the contractual cash flows and the interest, because of the SPPI is the principal and interest, this will call a classification of amortized cost. So the naming convention in classification is also the measurement principle. So the classification is called amortized cost. Measurement is an amortized cost. Okay? Then if you have a business model which is held to collect and sell the financial assets, and at the same time, this instrument meets the SPPI test, then it will be classified as fair value to other comprehensive income. So for short, I will call it FVTOCI, fair value to OCI. Okay. Now here the label indicates that there is a with recycling. Okay. Now what does it mean by with recycling? So the other comprehensive income is a separate statement from the profit and loss. Okay. But in terms of presenting the statement, you can either put as 2 separate statements or combine one with clear indication of profit and loss and the OCI. So anything that goes through the OCI you will see a corresponding entry in the equity statement. Okay, so in the previous version of IFRS, we had this direct to equity, right? So there's no such thing as OCI back then. But when they introduce OCI, it is to replace that direct to equity. So we will see it going through the OCI into the equity reserve. So when we say with recycling, that means when this financial asset is being derecognized or disposed of, the cumulative reserve that's sitting inside the equity will recycle to the P&L. Okay, that means in terms of the financial performance of the company, financial performance is expected to be shown in the profit and loss, right? So we always measure how well the company does based on how much of profit they make. So the intention of having a profit and loss statement is for the normal ordinary course of business. The true income and expense and the hit of the nature of the normal ordinary course of business will hit the P&L. So the day you actually de-recognize this fair value to OCI financial asset, you will see the flush out to the P&L, the net gain or loss for this financial asset. Okay. Then in terms of these two categories, the preparer is able to designate, so they can intentionally select to account for this as a fair value to P&L. Okay, so this can only be done on the initial recognition of the financial asset, and it cannot be revoked. Okay, so the moment the preparer decides to do it at the first time, he cannot change his mind after that. It's only a one-time designation. So what is the implication? Everything that there is a fair value movement in any of these financial asset will hit the P&L. So that means it causes a fluctuation in the financial performance of the entity. Okay, now we have a third category. Okay, so in the event that the SPPI test is met, but it is other than held to collect or held to collect and sell, it will only have one way to classify, which is fair value to P&L. So if you look at current scenario, based on purely business model and SPPI test, you only have one way to get to amortized cost. Only one way. It must be SPPI test met and the model is held to collect. So the common financial asset would be your trade receivables. You expect to collect the full amount of receivable, and a receivable would meet the SPPI test. So that will be accounted for as an amortized cost. Now the last category is if it is not an SPPI test met, so it fails. So the moment it fails an SPPI, regardless of what is your business model, you only have one way to go, which is fair value to P&L. So ultimately, all the financial asset would eventually be expected to be fair valued unless it is like a normal receivable, typically, right? Or a borrowing that is expected to be collecting the full principal and interest. Then you carry an amortized cost. Now, if you don't meet the SPPI test, this would commonly be those equity instrument, right? Because equity instrument, you cannot predict the upside or downside, that would be a fixed, like a principal amount, right? Because it fluctuates. So there's no choice, fair value to P&L, okay. But the standard do allow on initial recognition again, a one-time designation. If it is an equity instrument and you are not being held for trading, you can avail the fair value to OCI designation. Okay, so commonly, this would be like simple investment that you do not actively trade because you are holding it for maybe strategic reasons. If you trade it, anything that you do in a normal, ordinary course of business of buying and selling, which is trading the instrument, you must always hit the P&L because the P&L captures the day-to-day operation that is in the normal, ordinary course of business. So that's the logic behind why the standard is created in such a way. So for this fair value to OCI, this is without recycling. That means later on, when you dispose of or de-recognize this equity instrument, you will not hit the P&L ever at all. So if you think about it, right, if you are holding an equity instrument for long-term strategic reasons, they are not in a normal, ordinary course of business, then it won't hit the P&L. It won't disturb your financial performance, your day-to-day one, okay? So that's why it doesn't have a recycling effect. So what happens when you de-recognize it, right? So whatever reserve that I have, I will transfer it. I can transfer it to other equity item. So the standard doesn't say where. It only says you can do that if you want to. So typically, we will expect companies will just transfer to retained earning, the other equity item. Okay. So now we go into more detail about the business model and contractual characteristic. So easy for me to say using that diagram. Okay, this can be a reference point, but we need to understand clearly what does it mean by the business model test. Okay, so business model is something that is specific to the reporting entity. Okay, now even as auditor, I can't say that your business model is wrong because it's how you manage your business. Okay, now but if you tell me your business model is to held to collect, but when I audit it, you have been selling, or there are other evidence that suggests you do other thing, I will challenge. Okay, so business model is a very specific to the company. It's how they have decided and planned to run its business, how it plans to operate and manage its financial instrument. Okay. Sure.
Can you please speak louder?
Okay, in the old standard, IAS 39 and the new standard, I just want you to connect, because in the old standard that we got four classification, and I want you to connect the old way classification and the new way, and the people get easy
Okay.
to understand.
So IS 39 is a very rule-based classification, okay? So if you meet this criteria, you classify as this. You meet this criteria, you classify as this. Now for IFRS 9 is more principle-based, okay? So the four classification in IS 39, you have held to maturity, right? You have fair value to P&L. You have the available for sale, okay? Basically, you in the name itself is as good as is intended to be sold, right? And lastly is loans and receivable. Okay, so loans and receivable are amortized costs. And if we transit into 9, the only way from amortized cost to amortized cost is this category, right? So in the IAS 39, you have things like trade receivable as well that would be the loans and receivable category. You will expect to amortize cost and retain as amortized cost. Okay, then you have fair value to OCI. So the only equivalent one in terms of accounting treatment in IAS 39 is AFS. Okay, AFS was intended to be a residual category. So when we say it's rule-based, then in terms of the hierarchy of how we do the classification, anything you designate will always be based on designation. That is provided you have met the requirement and is allowed to designate. Okay, so anything that you designate specifically to fair value to P&L will be fair value to P&L. So in 9, same. Anything you specifically designate fair value to P&L will be fair value to P&L. So that one is pretty similar. Then another way to get into fair value to P&L in IAS 39 is held for trading. So why is it to P&L? Again, it's back to profit and loss is your day-to-day, right? So IAS 39 say that if it's held for trading, it goes to P&L. So anything that is held for trading, okay, any other, because you're not intending to collect and sell. So here is very specific, yeah. You must have both, to collect it and to sell. Trading is expected to mean selling. So if it's other, you end up fair value to P&L as well. So you might not see a very significant difference between the held for trading, which is fair value to P&L, to the current fair value to P&L as well. Okay. Then fair value to OCI. Here, one category here that we may see is like bonds, right? They could be held to collect because they have contractual cash flow, right, of principal and interest, but I may sell my bond because it could be like a quoted bond that I could just sell it eventually. So bonds may actually fall into fair value to OCI with recycling. Okay. Now for AFS in IAS 39, they are basically saying that if you designate it for AFS, then you do AFS, which is fair value to OCI. Okay. Now, the other way to fall into AFS category is it says does not meet loans and receivable. Okay. It is not designated as fair value to P&L. It is not held for trading because those would have been at fair value to P&L. And lastly, it says that you have the intention and ability to hold to maturity, then it goes to hold to maturity. So anything else that fail become AFS. Yeah. So held to maturity, the key difference between held to maturity and for the loans and receivable is that you have a maturity period. So how do I explain the difference? For receivable, I may have a credit period, but even if you breach the credit period, it doesn't expire, right? So unlike like bond, if it reaches the credit period, the person have to pay up, okay? So for held to maturity, it clearly says you must fail loans and receivable. So if you follow the thought process, the moment you classify in loans and receivable, it will never go into held to maturity. Yeah. So for here, so for the specific designation for AFS, you may have similar category here because a lot of AFS, you see equity instruments inside because it will never meet loans and receivable. It will never meet held to maturity. And if you are trading, it goes to fair value to P&L. If you're not trading, then it will become OCI. Yeah. So the expected change from 39 to 9 is mostly in the equity instrument side. So in the 39, they are a bit slightly relaxed in terms of AFS. You have a cost option, right? So non-quoted equity instrument, they may actually elect, not to say elect, they actually account for it at cost. Now, as we go into IFRS 9, everything must be fair value, right? So here, your equity instrument, you have fair value to P&L or fair value to OCI. It don't have a cost option. Yeah, but I will talk a little bit later. If I cannot get the fair value, then it can be cost. But like what I mentioned yesterday, that hurdle is quite high. Like you have to really fail it before you consider as a cost. But the moment you can determine the fair value, you must always revert out of cost. Okay, just like how we do property, plant and equipment. If we have a sorry, not property, plant and equipment, it's an investment property that you decide to carry at fair value. Sometimes things may happen and fair value you cannot determine. Then they say temporarily you